Welcome back to our monetary policy special. I have been speaking with perhaps the most elite of panelists. I have with me SBI Chairman Mr. Khara, Prasanna, the head of global markets at ICICI, Somran Chakraborty, Chief Economist at Citi, and Mridul Sagar, former MPC member and ex-RBI ED. Gentlemen, thank you very much for your patience. Mr. Khara, I know I can't hold your patience for much longer. Two very quick questions. Would you worry a little bit about the capex cycle? Are you, there are growth clouds more than interest rate clouds. Your thought on that?
Well, I think it might have some momentary effect, but nevertheless, when it comes to the investment capex cycle, we have generally seen that once the capacity utilization inches towards 75 to 80%, there is a very clear visibility in terms of the investment expenditure. And if we look at the 140 basis point of the increase in interest rate has already happened in the current year, but we have got a strong pipeline which is still seen. And interestingly, almost about 70% of that pipeline is coming from the private sector. So that very clearly augurs well in terms of the likely scenario in terms of as far as the investment expenditure is concerned.
And another quick question. I got your point, sir. Another quick question before I let you go. This is not connected to policy, but there is an expected loss, credit loss discussion paper that is coming. So we will go towards Ind AS. Does that worry you if Ind AS is imposed, say, FY25? I don't see it in FY24 if it is only a discussion paper now. But you think banking system is good to go for Ind AS?
I think if we look at the kind of gross NPA and the net NPA which is there in the system today, and the kind of PCR which the banking system is holding today, perhaps it is the right opportunity and opportune time to really evaluate our migration towards Ind AS. It might have an impact when it comes to the stage 1 and stage 2, but even stage 3 also, there would be a recalibration which will happen. And I think it's a welcome step which RBI has initiated today in terms of going for a discussion paper on the subject. It might have some impact for the provisioning, but I think eventually it will be in the overall good in the long term.
Okay. Thank you very much, Mr. Khara. Really kind of you to spare time for me all the way from London. We have to now discuss what it immediately means to the market. This is a discussion paper, and maybe a year down the line, banks have to provide more, but we don't have to worry about it now. Prasanna, I wanted more your thoughts on where do you see the 10-year peak, the 1-year OIS, and more importantly, rupee. Do you think the threat is over for now?
So, Lata, on the bonds, very quickly, I think we are back to the grind, so to speak, with the global environment being bearish. We've seen this policy which has come on expected lines, and we've seen the governor kind of tick all the right boxes, very calming influence. So we've seen that behind us now. But now we'll have to again look at what's going to happen in the US as well as in the UK, as well as what's happening to the bonds there. And what has actually happened over the last month or two is the Indian bond yields have not really, I would say, reacted as much as what it might have had, basically because of the expectations on the global bond index inclusion. And a lot of discussion has already happened under that, so I don't want to really, extend my arguments on that. But just to say that if the inclusion does happen and the announcement happens next week, then you would see, bond yields falling by around 15 basis points. And on the other hand, if it doesn't happen, we'll probably see the borrowing program grinding bond yields gradually going up. And the other thing which is affecting the bond yield curve is, of course, the heightened liquidity shortage that you were talking about, in the sense that now the interbank rates are tracking MSF rates and not really the reverse repo rate, as was the case nearly a year ago. And so to that extent, there is a natural grind up in terms of where bond yields are. So, and also to add to that, the fact that the SDL supply is also now coming in, going to hit the market in the second half. So all in all, I think I would call a range of around 735 to 760 if nothing happens on the global bond index.
Okay.
And I'm also capping it at 760 primarily because I do see a lot of insurance-driven bank, HTM-driven buying, which is happening when really yields go up. On the currency side, Lata, I think again over the last 2 to 3 weeks, especially post CPI, it's really been dollar strength all the way because the interest rate expectations on the Fed has really got repriced in the global markets. And during that period, we've seen the dollar appreciating against all the the G7 currencies quite substantially, and INR has also kind of fallen prey, much less though than what the others are. So having said that, I do think that the period of dollar bullishness is still going to remain globally. But on the other hand, I will also say that incrementally there are more and more reasons to be less bearish on the INR beyond this level. Maybe a level of 82.5 is what possibly it can go. And I'm basing myself on the fact that the dollar strength can actually start to wane as we go forward, because the arguments of differential interest rates, differential growth, and differential safe haven demand, which is what has driven the dollar so far, will probably, kind of get less and less important as we go forward.
Well, since we have a city economist with us, that question to you, Samiran. There was a seminal mood shift in the currency today, not entirely due to the monetary policy as much as the dollar peaking off. Is 83 on the cards, or is 82 likely to be, for some time?
Our global strategists, they believe that there is still some dollar strength left in the system. And that's why we are in the short term thinking of even 83 happening. But this could be a very orderly move in the currency markets rather than being knee-jerk in nature. We, at least at this point of time, feel that the worst of balance of payment situation is behind us. Second half, both the current account deficit as well as the overall BOP should look slightly better, giving RBI a bit more wiggle room to operate with. And on top of it, as the governor has mentioned today, that a large part of the FX reserve decline is on the back of valuation adjustments and not directly interventions. So these valuation adjustments can work on the other side also. If what Prasanna was referring to, if for some reason the Fed pivots and yields come off, then that automatically leads to our FX reserves optically looking higher. And the same can happen if the dollar cycle turns at some point of time over the next 6 months or so. So all in all, I feel less worried on that front on RBI's ability to defend the currency.
Okay, that's very welcome if you think you are slightly less worried. Mridul, the most important question to you really is, how will the Reserve Bank look at that 4% target, or rather the MPC? They have to write this letter to Parliament defending their inability to bring interest rates below 6% for 3 quarters. It's going to perhaps remain above 6, as you yourself said, for 1 more quarter. Will they not attempt 4% at all? Is 4 to 6 going to be their target?
Yeah. Lata, if you allow me, let me first quickly react to the discussion which was going on before this thing. In my view, the global financial markets are still into choppy waters. I mean, it's too early to sort of say the Fed has peaked. Barry Eichengreen and NCR took the call of 5% terminal rate for the Fed. We still sort of believe that. And there is still, on the currency market, so much is happening. I mean, you look at the yen-dollar volatility. I mean, from the fall, it's back to 145, 144 levels after the Jackson Hole speech of Powell. So dollar strengthening is something we can't really say is over. I mean, we still have to wait and watch how this pans out in terms of it. And I think the EM currencies will still need to bear some sort of a onslaught in the coming period. Equity markets correction is also not over, in my view. There's some work which has come from the Chicago University earlier this month, which shows that the investor habit formation is such that we could see a short-term interest rate rise would lower output and consumption levels, but will raise risk aversion and amplify the global shock.
Okay.
So the house price bubbles could burst in places, Australia being one of the immediate evidence of it.
Oh.
So I think we need to be very trained and very nimble and flexible-footed, as the governor had really explained in his speech also. So at the moment, 4% may not be the immediate possibility. So I think it's okay. I don't think there needs to be a stigma attached to RBI explaining the letter. These have been very special circumstances in which inflation has gone up. So what one needs to watch out is how credibly the central bank explains why it has gone up, what it will do to bring it down. So these are very critical next forecast. Okay. So it's okay if inflation stays high into the next year, but that only means that the monetary policy needs to remain tight for some time now.
Point taken entirely that in special circumstances, stability is more important, financial stability, than perhaps adhering to the targets that were set in more normal times. It's been a most enlightening discussion. Mr. Khara, Prasanna, Samiran and Mridul Sagar, thank you very much for joining me. We wrap up on this special broadcast on the monetary policy.